Let's bring on Tim Quas. Welcome back. We got the dance moves and we're ready to go. Looks like you got the better shirt than all of us, though, I got to say.
He's dressed to impress.
I'm
This
still
guy
on island time.
looking like Jimi Hendrix over here. I like it. I like the shirt.
Hey, good to see you guys. And Market Structure Monday is right where it belongs, which is on Benzinga pre-market prep. So good to see you all. And yes, I'm still, while I returned from Maui yesterday morning, I'm clinging to the past in my garb today. Yes.
I can't hate on that one.
It's the only place where you could get away with wearing stuff like this, right? I drag this stuff out when I'm in the islands.
Beautiful.
Well, you're a rock star, Tim. Now give us the rock star charts. What are we seeing out there? What should we look at?
You could probably tell that I was eaten like a rock star because I put on about 7 pounds on that trip.
No way.
I'm gonna have to give up the Maui brewing brews and return to salads and iced tea.
Huh.
So I heard part of what you were talking about, and Joel, you had mentioned that it's in our notes that we traded that it's a quad witch. But if we just, so we'll definitely want to talk about that. Again, I go back to the way we think about the market isn't headlines. The trouble with headlines is you have no idea whether there is underlying support in a stock or in the market to reflect headlines. And that's, I think it's very difficult to trade prices. It's much easier to trade supply and demand, which I did from Maui. I mean, I had a great week, and I didn't have to do much. Did it all on my phone, and it's by just using supply and demand. So that, to answer your question, Mitch, if you say, well, where is the market? My first response to that will be, well, where is supply and demand? And if you like, we can look at that. For those who are used to seeing this, I always look at 2 charts: supply and demand. Supply is short volume. It's the amount of trading volume that comes from shares that are either it's all borrowed, but a major part of that is manufactured liquidity from market makers. They're borrowing it too. And then demand, the way we think about it, is an algorithm that looks at the different purposes and time horizons that drive buying and selling in stocks. So investors and traders don't all have the same purpose. So I will look at that every day. The first thing that I do every day is look at broad market sentiment. Notice that it's 2.5. Well, historically, the market trades around 5.5. It's a 10-point scale. So the more time that stocks spend above 5, the better they tend to do. 5.5 would be what I would call a very good GARP, growth at a reasonable price sort of market. The more time they spend below 5, the worse things tend to go. But when the market drops below a certain level, that the probability that prices rise increases significantly. So on my screen here, just looking at the period from June 9, which picks up all of the gains in the market, to present, this is through Friday. The top graph is demand. So this green thing is just going to meter what investors and traders are doing. And most of the time it's between the red and green lines. That on average. When it's above the red line, greater risk that there will be declines ahead. When it drops below the green line, greater probability of gains. And it's very consistently true. It's math, it's quantitative. But the reason that works is because that's how the market functions. A great deal of what occurs in the market is quantitative. So if you want to understand the market, you'll have to incorporate that math. So when the market dropped below, this by the way, is SPY. Price of the S&P 500 is represented by the oldest and largest exchange traded fund from State Street. So here's what the market did. We've had this very nice recovery once the demand side dropped below 4, dropped below the green line. I now know that I have a much better probability of making gains. Even stocks that have declined, if I have positions in stocks that have declined, I will wait longer to get rid of them because I know mathematically there's a probability of gains. Now look at the supply side. The supply side again is short volume. I'm going to zoom out a little bit here. So here's the supply side. We have hit record levels of supply. Never before has the whole market been over 50% short. Now, the good news is it ticked down a little bit on Friday. This will chop block the market unless it comes down. The gains that we had off of June lows in very large part came from falling supply. See the supply line falling all the way down here. This was a key reason that the gray part of the graph rose all the way to here. And the market staged this remarkable recovery. It reached its zenith. The recovery reached its zenith when supply reached its nadir. They're exact opposites. So the market has recovered as expected. I traded Meta, META, Facebook, WEC, Wisconsin Electric, Celsius, CELH, all things that I traded in the last week and did very well on. I had a very good week, and it's because I know that we're going to have a short-term run. But a good rule of thumb is that unless the supply side reverts to the trend, the likelihood that this is sustained is not going to be anywhere near what it was when the supply side fell all the way from June to August. So I think this is a period where it's very challenging for traders. And it's got nothing to do with fundamentals, folks. It doesn't matter what interest rates are. It doesn't matter if inflation is coming down. A great deal of money simply says, well, this stuff is oversold and that stuff's overbought, and let's shift it. And that will cause the market to do things that people misinterpret as some kind of fundamental driver. But I remain concerned about this. I'll say again, this is what we're telling all the edge users to watch. And we will highlight things that we would say, these are the right kinds of supply-demand balances, but this is dangerous. It's why I sold all my positions Friday. I don't even want to wait over a weekend. I can buy them again today. But I can't get it back what I lost if I give up all the gains. I would rather take gains, not chances, than stay in the market under these conditions, even though I think we will see further gains yet in the market.
Real quick question, just Tim, if you could say kind of quickly, a quick explanation for me. What should we think about when we see a broad sentiment divergence from the price there? So you see a broad sentiment coming down, but the SPY still coming up.
Yeah, well, it tells us that the market is the reason stocks have recovered is because they were so oversold that any little increase in demand can cause prices to go up. But you're right. The fact that the demand side hasn't even turned yet, and we have all these gains, it's difficult. It's challenging. That can be nothing more than new month, new money. We talk about that. That is, as a new month begins, there will be steady inflows. I still make contributions to my long-term portfolios that will have to get deployed. I've changed them some. So that effect can cause the market to rise simply because we're at a bottom. So you put something to work and it will cause prices to rise. It's interesting that the broad measures have risen, but the market itself has been pretty mixed. And you could really see that in the data. And then the consequence of that can be that it suddenly vanishes. I'm not saying that will happen, but it is a risk here.
So everyone selling a rip is what you're saying here. That we've had a nice bounce, and people they're still, besides the rally, there's still preponderance of people willing to sell into strength here as opposed to weakness, right? They're taking the opportunity when there's strength in the market to sell into strength. And I think that's one thing that you have to keep in mind is when like we had the big moves off the low last week, and the indexes and stuff. Then once you get far enough away from the low, there people are like, okay, I got to buy the pullback, right? And now we're seeing the opposite on the upside here, right? We're having a nice run. We don't have a good stickling point here. You could still sell on strength today. So is that the scenario you're setting up that the preponderance of people are just selling the rip here as opposed to reloading here and looking for another leg higher?
Joel, I don't know what will motivate other people.
Well, you
I
knew
only
when we
know what
came
should
down, when there was a reading down there, you knew that we were going up. So,
Yes, right.
so you know when we're going up, then you got to know when we're going down.
I like to think of it this way, and I'll answer by looking at Meta. So here's, why did I buy Meta? Well, demand was right, and I didn't hold it long. So,
Okay.
2-3 days. So here, the green part's rising, and it's at 5. That's what I call a big and stable stock. The supply side fell, but it ticked up Friday. So when I looked at that data, that I'm gonna leave. It doesn't take much. Those conditions tell me you could continue to make money in Facebook and Meta because the supply side is still below trend. But that's the principle I look at. The whole thing that I care about is diverging supply and demand. I know in the broad market, when the market drops below a certain level, it is very historically true that the market recovers. And you can go look at this. I'll just back up 3 years, and we've done this before. You could look at the points in time where on the demand side, the green part of the graph drops below the green line. Almost always stocks recover. And so that's where it is now. So I know the odds are in our favor, but I also know that when the supply side is very high, like it was here, a dip like this can very quickly deteriorate into another turn lower. So that's why I'm much more careful when the supply side is high. I hope that makes sense. Supply and demand are basic economic principles. When there's more demand than supply, prices rise. When prices recover and supply remains high, there is a very high probability that the stickiness of those prices is lousy. And so I don't know, I don't think that that's necessarily what people think about, Joel. I think that, you've got fundamental folks concerned about the fact that analysts are reducing their expectations for earnings growth. I saw somebody on CNBC this morning say that they could be cut to 0. Well, how could the market be higher if there's 0 growth? Again, fundamentals are only one input into the market, and they don't determine all the outcomes. But I think that causes people, Joel, to be sellers of the rip, so to speak. Again, I bring a different perspective to how to think about those things. I just come back to supply and demand, by rising demand, diverging supply and demand, and sell it as soon as any of those conditions change. Because if you repeat that, that is the thing that works best to produce gains and avoid losses. That's all I'm concerned about.
Can you just explain how you calculate that supply again, Tim, especially to people who have maybe are newer to the show? I know you've explained this on the show in the past, but can you just explain how you calculate that?
So oversimplifying, we think about the market as having 4 key motivations. There are a bunch of machines and people who trade price. So it's half the market. That's a motivation. There are people who buy and sell story. What a business is doing. Why is this company better than that one? Why is NVIDIA a great long-term buy and hold stock? Then there are third, passive investors who use a model to say we're going to allocate a certain amount of resources to this or that, or 200 different factors in a factor model. All of that is model-driven money. And fourth are derivatives. So price, story, could say passive is characteristics, and derivatives all affect price and affect how the market behaves. So we have an algorithm that takes that into account. Plus, it takes into account how trades are executed today. The market is 100% electronic, over 97% algorithmic. Even you, retail traders, when you hit a button to buy and sell, most of the time that's going to be an algorithm that executes the trade for you. And those are mathematical things. A whole series of events will unfold. Well, that is all mathematically measurable. So we turn that into an algorithm that we call sentiment, and that is demand. And that's what we're doing. We incorporate how those things are evolving over time and affecting prices. You don't have to worry about all that. But we've been doing this for 20 years. And so we've kept up with the way that the rules change. And it makes it very simple to think about the market as supply and demand. And here's a great illustration, right? Look at Benzinga, September 12th. I've got demand at 5, falling supply. That's the stuff I like right now. I would rather buy supply deficiencies than demand excess because I don't trust the broad market right now.
Is there any stock that would fall along these lines with short volume coming down, sentiment coming up?
Yeah, I mean, right now these are things that to me the math gives support to. Now realize they're not sexy. I'm not going to make 5 or 6% like a Meta, and we track that. Most of the time, volatility is a very good indication of the amount of return you could expect. But EverSource, which is a utility, Philip Morris, I mean, cigarettes do well in this kind of environment. Philip Morris and Altria are both in there. Elevance, which is a healthcare company. These are all things that to me you could make 2% on. So how I look at this is if they're down 1.5%, there's a very high probability if I buy that, and then they hit maybe the next day, the full extent of their intraday move from highest to lowest. That's what volatility is. I can make 3%. Well, I'm very happy with that. If you can make 3% on your portfolio consistently, you will be very wealthy. That is a fact. It's far superior to buying and holding. I was a friend of mine who's got a big tech long-term investment. He's down 25% this year, and there are a lot of people in that boat because the Nasdaq is down 25%.
Yeah.
Well, I miss all of that. I don't hold the declines. I only buy the gains, and so I can be up in the same things that he is down 25% by simply shortening my time frames. I don't love that. I don't love the way that the market works, but it is a fact that that's the way it works, and you have to use it to your advantage.
I like it. I like it. One of these was actually on my radar today at ELV, so definitely going to go ahead and check it on out. I like the chart pattern, and getting some data to back up my patterns is something that I definitely look for. So here you guys have it. Definitely go ahead and check out Market Structure Edge for yourself, guys. If you guys want to follow along with this data, all you got to do is just go to the website. You don't even need a credit card to check it on out.
Exactly. And we're working on that 30-day trial. So and you can just ask me. It takes time. There are so many connected items related to it that it takes a while. So it's still a 14-day trial, but you can just send me a note and we'll extend you.
Well, like Joel said, aloha on out there, and enjoy your week back. And we all love the shirt,
Thanks,
so have a
Tim.
good one, Tim. We'll definitely have you back on.
Mahalo. Aloha.
Mahalo. There you go. I love it.